I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast. Today, we are talking about mortgage insurance, answering all those common questions people have about it. And Tom, what do you think some of the big questions have been, or
Mortgage insurance. What is mortgage insurance? Is that homeowners insurance, or is that mortgage insurance? Like, what are we talking about? Holy cow! We get all kinds of questions about insurance, but this is not having to do with any type of property insurance. This just has to do with insuring, basically the lender against potential non-payment. This is insurance as it relates to your mortgage payment.
Yes, this benefits the lender, the bank.
And I will say this, because it benefits the bank, it benefits you.
Right.
Probably sound like something that your parents would say.
That's a good point. I mean, because the banks are protected by this insurance, they can offer you something in return. And
right.
So that's what we're going to get into.
That's exactly right. So I guess one thing we can do before we start is, if there was no insurance, the minimum down payment would have to be what? 20%.
Really? 20%.
Imagine that, 20%. So when you see insurance, just think, oh, thank goodness. If it wasn't for insurance, loans wouldn't be available for what? 90% of homeowners.
Oh yeah, for sure. And especially for first-time home buyers.
Exactly.
So, I think that in the beginning here, let's talk about the question of what is mortgage insurance and how does mortgage insurance work? The first thing we've already just talked about, the first bullet point really is 20% down. That's when if you have 20% or more down or 20% or more equity in your home, you do not need mortgage insurance. So what we're talking about is mortgage insurance that applies if you have less than 20% equity.
Right. Now, and if we were to back up even more and just say, okay, so why does the bank need insurance? Why is a 5% down payment just not good enough? Well, because what happens is in the event, and this is rare, but in the event there's an economic point in time where a payment is not made or a borrower is not able to make their payment, this insurance will help the lenders recover some of their losses. So this really is insurance protecting the loan that they gave you in the event you were to stop making payment.
Yeah.
So let's just say that you buy a house for $400,000. Let's say that the you put 5% down. 5% down is what, $20,000. So the bank gave you $380,000. The Great Recession hits. Your home is only worth $340,000. The bank has a loan for $380,000. Yet your house is only worth $340,000. What do? Well, the homeowner walks away, and the lender is stuck with the house. So this insurance helps them get whole.
And in your situation, there is usually the bank wants coverage, and if you have a 5% down borrower or 5% down conventional loan, they want 35% coverage, which if the home was $380,000, 35% of that would be $133,000. So they have $133,000 in insurance. Again, this is for the bank. So if your home loses more than $133,000, or they suffer the loss of $133,000 or more, they get hurt. But if the loss is less, they're covered.
They're covered, right? Good point. So, and that's like if we were in college, that would be like a 200 or 300 series class, because the actual insurance coverage is going to be different than the actual, down payment LTV. Because typically, if you put 20% down, no mortgage insurance,
right?
Okay? So the lenders, would only have coverage for that 20%. But what you just said was they actually get coverage for more than that. So there's some little nuances in there, which is a little advanced thinking, but I'm glad you brought that up.
Yes, which is the mortgage insurance actually protects the lender really more than that borrower with 20% down, and as a result, that is why the interest rates, people, are a little bit better on loans, that the loan to value is when they're above 80% loan to value. So if you put 15% down, 10% down, your interest rate on a conventional loan is a little better. We talked about that. And the reason is because it's actually less risk. because of that.
Yes. Huge. Yeah. And Ed, that's like a 400 level class that you just said there. That's a really, really big deal. Because a lot of people don't know that. And we could have a whole separate podcast on that, but that's exactly right. Interest rates are actually slightly better because of the mortgage insurance. It's phenomenal, because what happens is that lender that gives you the money ends up selling it. And when
Yeah.
they sell it, and Fannie or Freddie buy it, they say, hey, guess what? We're selling you a loan with insurance on it or a loan without insurance. If you're buying a loan, which one would you buy? The one with insurance. So,
Right. So there's really 3 different products, loan products that we use, right? It's FHA, conventional, and VA loans. Okay. And all 3 of them have a version of mortgage insurance.
mm-hmm.
So what we've been talking about is conventional financing, and conventional financing technically right now has a minimum down payment for certain borrowers of just 3%. So if you just have 3% down payment, you can get a conventional loan. And that,
Mm-hmm.
of course, has mortgage insurance. The FHA loan, they do not call it. Let me just go back a little bit. Conventional financing. No, I'll continue on FHA. FHA has a mortgage insurance premium, but again, an FHA loan is a government insured loan. And so that insurance, it doesn't matter how much money you have down. There's no FHA does not distinguish between 20%, 15, 50% down. You're going to be paying mortgage insurance on an FHA loan no matter what.
Right, that is correct. Yep. And they only have one little price difference, is if you pay more or less than 5%.
Yes.
So if you were to put down 5% or more on an FHA loan, you'd have a slightly lower insurance premium than you would if you put less. But other than that, yes, no matter if you put 90% down,
Yes.
you would still.
Okay. So the other programs, we conventional, then FHA, and then now the VA loan. The VA loan does not technically call their insurance mortgage insurance. They have it classified as a funding fee.
Mm-hmm.
And
it's a one-time fee. So unlike the other 2 groups that have this reoccurring, it's a one-time fee.
Yeah, and an FHA, kind of go back, FHA has that mortgage insurance that's both upfront and monthly. So there's 2 versions of the mortgage insurance. And again, it's a government insured loan. It's for lower credit borrowers usually, and the government they actually have this big pool of insurance that all those premiums go into.
Mm-hmm.
But for the VA loan, even though it is a government, it's still a government loan, but it's not a guarantee. It's not insurance. It's actually a guarantee. The VA guarantees that the lenders will be made whole. And that's the distinction between FHA and VA. Mm-hmm. FHA has a government insurance. The VA, on a VA loan, it's a government really guarantee.
Right. And so the VA is not the lender. The
right.
VA is just the insurer.
Yep. And they gather, and so their premiums are basically gathered by those funding fees.
Mm-hmm. And they have a premium no matter you put 0% down or you put 90% down.
Mm-hmm.
So if you're a borrower and you've got 50% down, which I have literally a VA borrower today, they want to buy a $500,000 house and they have $250,000 to put down. They think the VA loan is the way to go. But I'm telling them that because of that funding fee, it's not. It's one of the cases VA, is not preferred over the conventional.
And VA veterans, if you are disabled, you are exempt most of the time from the funding fees. If you're disabled, you usually do not pay the funding fee.
Mm-hmm. Okay. How about jumbo? So jumbo loans, we do those here with the Mortgage Brothers team, and we don't usually quote mortgage insurance with jumbo loans.
Because there really is no private mortgage insurance in that realm. The lenders, what they'll do is, instead of insuring the loan with a mortgage insurance, they
insure it with a little bit higher interest rate.
Exactly. They give you a higher rate.
Mm-hmm.
So
if you were to call us and say, hey, you know what, I want to get an 85% loan to value jumbo loan, we'll give you that loan. At least we did before COVID, and hopefully it'll come back here soon. But that would not have mortgage insurance. It's not free. The lender's already calculating it based upon their risk.
Yeah.
But I don't know if this is appropriate, but how about like an 80-10? What happens if we did an 80% first loan and then like a 10% second? Would we still need mortgage insurance
No.
because we do an 80% first?
Yep. And so it was very common in the past to avoid mortgage insurance by doing a combo loan. Okay.
Mm-hmm.
So the second mortgage takes on that liability, being
Mm-hmm.
in second position. So
Mm-hmm.
as long as the first mortgage is 80% of the value, on a conventional loan, for example, you would not have mortgage insurance.
Yeah.
So it's
We
one way
don't
to avoid
Yeah, we don't typically recommend that. That's not like a tried and true strategy. Always do an 80-10, but in some cases that may work, may be preferred. But
Yeah,
wanted to
we've
throw that out.
actually seen. I mean, we used to do a lot of it in the past, but because mortgage insurance premiums have really, or the private mortgage insurance, the PMI has really come down. The rates have come down over the time. It's really been competitive and
Hmm.
really outweighed the second mortgage, I think.
But plus, you'll be able to drop the mortgage insurance once you hit that 80 to 75 or 78% loan to value. So to be
Yeah,
stuck with an 80-10 and have to refinance out of it doesn't always make sense. So,
yeah.
but it is something to kind of think about.
Okay, so the next question is, is that customers are going to have these questions like, for example, is mortgage insurance a bad thing? And they were going to want to know how is it, calculated, but
No,
is it a bad thing? And most people, when they call us, they think mortgage insurance is like evil.
right.
Last thing they want is to pay some in, mortgage insurance. They're so afraid of this mortgage insurance.
Right.
And
No,
anyway,
yeah, it's a wonderful thing as we started our program because without it, that mortgage would not be available.
you would have a lot less homeowners out there, and you would, again, the advantage is you get, to really put down the minimum of 3%.
Yeah, that's
Okay.
right. That's right.
Um,
How,
but the,
how about how about real quick? Any difference between second homes, investment properties, and primaries?
yes, I mean, the mortgage insurance is applies to, all
It
three.
Yep, all
You can
three.
you can technically get mortgage insurance on an investment property. You can actually put 15% down on an investment property, but almost nobody does it because the mortgage insurance is really expensive.
Right,
It
and
defeats the purpose.
so close to not needing it. But yeah, so that 80% rule, it applies across the board, whether it's primary, secondary, or investment property.
Yeah, and so you get better rates as if it's a primary, a little bit worse rates if it's a second home, and then the very worst mortgage insurance
Okay,
on investment.
but for those looking to maximize their ability to leverage, they would bring on the private mortgage insurance factor, only put the minimum down of 15%, use that extra 5%, had the tenant end up paying that mortgage insurance and going out and buying another rental property. So we see a lot of investors that frankly pass that cost along to the tenants.
Okay.
What else?
Okay, so one question is does the mortgage insurance affect the debt ratios? I mean, so if a borrower, and for some people, you're wondering what is a debt ratio? It's your monthly debt divided by your monthly income. And the answer is yes. If the mortgage insurance does affect, does affect your debt ratios, and interest rates, or sorry, the mortgage insurance rates themselves are really based off of the loan amount and the credit score and the loan to value. Okay. And that's how we figure out how to calculate the actual mortgage insurance payment. So the
Mhm.
larger the payment really is, it's counted in your debt. Okay. So,
So yeah, so I was working with a borrower looking at a conventional loan. They had an income of about 7,000 a month, and they were looking for about a $400,000 house, and a credit score was not very good. And when we did the private mortgage insurance factor, it came in at $350, or what was it, like $310 a month?
mhm.
So $300 a month. If his income would have been 6,000 a month, that's almost a debt to income hit of like 5%, right? Am I thinking about that right? If it
Yeah,
were
could. Yeah, for sure.
if it were a 10% hit, it'd be $600.
Hmm.
So for people that are struggling to fit within a debt to income ratio of under 47% or under 49 or 50 or whatever it is, if all of a sudden you have to factor in 5%, that could impact things.
Yes, it can. Okay, so I think the last section here we wanted to cover is how to avoid mortgage insurance, and of course, by putting 20% down on a conventional loan, that's how you avoid it on a conventional loan.
Mm-hmm.
There's no way to avoid it on FHA, and if you're not a disabled veteran, you cannot avoid the funding fee on VA.
Mm-hmm. So really, the only way that you could theoretically avoid private mortgage insurance is, number one, pay at least 20% down payment.
Hmm.
And if you were to do a 90-10,
Right.
I'm sorry, 80-10. If you were to do
Oh yeah, combo loan. Yeah.
a first mortgage, second mortgage combo,
Hmm.
you're really avoiding it, but you're still paying for it because you're having to pay for that second loan, which is always at a higher interest rate. So there is really no way of avoiding it. We tell people, in this business, nothing is for free except for our great advice. But
That's right.
but nothing's for free. Down payments aren't for free, and mortgage insurance is not for free. But we do the best we can to get you the best pricing that we can.
Yeah. A lot of borrowers will ask, well, can I get a gift from a relative to pay down to use as a down payment
Mm-hmm.
to get rid of the mortgage insurance? Absolutely. Right. If it doesn't matter where the money, if it can be your money that you've saved or a gift from a relative, as long as your down payment is 20% or more, you can
Mm-hmm.
avoid the mortgage insurance. And
Yep.
if you've closed the loan and you put 5% down, and then a month later you get a gift from your dad.
Or how about this? A month later, you sell your existing home.
Well, right. I mean, yeah, if you have, okay. So if you sell your home or you get coming into money from a gift, you can just do a large principal reduction. And the bank will automatically, by law, on a conventional loan, have to remove the mortgage insurance when your loan balance reaches 78% of the original value.
Mm-hmm. You can
Okay.
request it at 80, but at 78, they're required.
Yes, it should come off. And again, this is all on conventional financing. And what Tom was really mentioning is, you can, a lot of folks will, if they have a home right now, they want to buy a new home. That is a different strategy we use. You put the minimum down, you put 5% down. Then once your old existing home sells, then you can do a large principal reduction. And
Mm-hmm.
also can do a recast with it, but we have another podcast talking about recasts. Okay.
How about the crazy idea where I don't know if they're overthinkers. I think it's probably worth it. But some people actually come in and they put 5% down. They get that little bit better closing cost factor, that little bit better interest rate, tiny
Mm-hmm.
bit.
Mm-hmm.
And then after the loan closes, they wait the 2 months that they're required to wait. And then they actually end up paying that extra 15% down.
Yes, this is a insider trick.
That's a total insider. Like,
And it really is something we should highlight. This is an insider trick.
you think?
Oh yeah.
Okay.
Okay. I mean, but it is hard for some folks to grasp it. But basically, if you put 19.5% down, okay, not exactly 20, you can pay a little bit of mortgage insurance. So I had a borrower who had a $300,000 loan and was only going to be paying like $20 in mortgage insurance for just a couple months, and they're going to do a principal reduction down to 78%.
Right.
And they got the
Right.
benefit of a lower closing cost, lower interest rate.
And they only had to pay $20 a month extra for like 3 or 4 months.
Mm-hmm. Now, some borrowers say, "Oh, that makes my brain hurt.
Right.
I just want to put 20% down." Okay, fine, but it saves you money if you do it that way. 19.5% down.
Right. Just call us and say you want the insider special.
Yep. Put 19.5% down, and then make a couple payments after we close.
That's
And then just pay down your balance to 78% of the value.
Yep.
Okay, so Tom and I, we do this every week. We want you to join in the conversation. We want you to be asking us questions. So be sure to email us Our information's in always the descriptions. Be sure to subscribe to our channel. We want more subscribers. We want you guys to really be involved. And I know that mortgages are not really exciting until you actually need one.
That's right. Kind of like, kind of like going to the, I don't know if I just say this, going to the chiropractor. It's like,
right.
Who gets excited about that? But when you need one, holy cow.
Yep. So follow us on Facebook. Reach out to us, through the messenger, any way you want to communicate, just let us know. And we just wish you guys to have a great week.
Yeah. Thanks for listening, folks.
Take care.
All right. Bye-bye.
Bye. Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to tom@azmortgagebrothers.com or yours truly at eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.